What's up you guys, Tommy Shaw here, and today what I'll be talking about is how to raise capital and grow a business, okay? So let's just look at how to grow the business, how to raise capital and grow a business, okay? So the first thing we need to understand, why do we say raise capital? Because when we look at a balance sheet, you have the assets on the left and you have the debt and capital, how you structure the business that you invest in assets. So when you have an idea, you have a concept, or you have a business that you're thinking about and you don't have money, well, how do you get money? From who can you get money? Why do you need to raise that money? Because you can't start a business without capital. That's why it's called capitalism. Okay, so you can get some from your family members. You can go see angel investors, but they'll have a big chunk in the business. But it's better to have something that they have nothing at all. You could save your money. Save your money when you're working for somebody else, you're raising that money, you're raising that capital, and then you have an idea. Well, you're going to use that money to buy assets. Because you can't construct a business or a balance sheet if you don't have any assets that are working for you. So you're going to buy equipment. It depends what the idea is or the concept is. And before you're raising capital, you're going to have a business plan, because what are you going to explain? You're going to be raising capital, but for what purpose? So you need to have a plan on where the business is going. Is it scalable? What are the investors going to be asking? Like, what is the rate of return that your investors are looking at? Is it a 15%? Is it a 10%? Is it a 7%? If you don't know how much percentage investors are asking, most of the investors are going to be asking around 15%. Okay, it's very rare that I see it below that, especially in a startup. They're going to be asking for equity, they're going to be asking for control of the business, something that gives them that access. Okay, so once you have capital, then you can start buying these assets. You could buy equipment, you could buy buildings, you could hire staff, you could brand, promote. Okay, once these assets are starting to do something, they need to produce, because if you're buying assets and they're not producing, it's impossible to have a financial statement, a profit and loss statement. Okay, so these are going to bring in revenues, then you're going to have expenses, variable and fixed. Then you'll get to EBITDA. The EBITDA permits you, it's earnings before interest, taxes, depreciation, and amortization, okay, or NOI for other people. So the EBITDA, what's going to happen is that debt holders or people that want to loan you some money are going to be looking at EBITDA, because they want to know if you have the ability to pay debt in the future. They're going to be looking at, okay, your equipments are starting to give you revenues, expenses, or maybe the EBITDA is a negative because you're investing more money than the capacity for the business to grow. So when you need more money, you're going to either have to raise more capital, going to the financial market to raise capital, or you're going to have to take on some debts or put in your own money. You could loan money to the business and put it as collateral, or put it as capital inside the business to make it a better sound company. Okay, so if this becomes positive, when it becomes positive and it's stable, then you can get to have debts. Usually the company is more mature, the business cycle is above the ID phase, it's growing, and it's starting to get mature. And just like when you're investing in real estate, the reason why real estate you're able to borrow money is because you're in a stable, mature sector. You're not going to be growing that business at 10% per year, 20% per year. You might be growing it at 3%, 2%. It's going to follow the same thing as inflation rate. So this is how essentially you get to grow your business, because the first thing you need is an idea, you need a business plan, and then you need people that are going to give you capital, lend you capital, or maybe invest in your business as a venture capitalist person, or it could be investors, outside investors that want shares, or your mom, dad. And you have to know how much investors want in your sector, okay? It could be a really good idea, but if you don't know how to satisfy investors' needs, then it will be impossible for you to have investors. Once you have capital, you start to build the business by buying equipment, building your brand, promoting. Once this is in place, it should bring you some revenues. You'll have expensive, variable, and fixed, depending on what kind of service you're offering. Is it a service, a product, or digital product, or something like that? Once you have a positive EBITDA, then you can focus on acquiring debts to acquire more equipment, buildings, brand, personal, or even like promoting the business. It depends on which sector you're in. But essentially, this is how you start a business. Because the reason why I'm doing this video is because a lot of people are saying, yeah, but you need money to make money. Not really. You don't need money. You need to know how to build a business. You need to know how to raise capital. You need to know how to find investors. You need to be known. People need to know who you are, and they have to have confidence in you. And once that's done, you have capital, you can invest in the business. And then once everything starts, people start to see that you have a great ability to borrow, pay back debts, you have a stable company, then you'll have access to a lot of debt. And this can go on as long as the business is growing, or your ability to pay debt is functioning, or the business is growing from a revenue standpoint, or just giving stable revenues or profits to investors. Okay, so once profits starts to be done, when you have profits down here, say you pay taxes, interest, depreciation, amortization, then you have the net profit after taxes, and this is what goes to investors. Okay, if you have $1 million of profits and you have, let's say, 10 investors, well, all investors are going to receive $100,000 either from a dividend or salaries. If you give them salaries, then each person has to declare taxes on those revenues. The same thing for dividends. They go on to your personal revenues, and you'll have to pay taxes in accordance with how much money you're making throughout the year. So essentially, this is how you raise capital, and it's not giving you an ideal to start a business. I'm not giving you guys anything like a concept or something. What I'm trying to help you understand from a business side of investing is how to raise capital, invest it, and grow the business. Because that's what I did when I started out in 2011. I borrowed $18,000 from my mom's parents. $18,000. It was like 3% a year, and we paid it off in about I think it was 7 months. And we just, even though the interest was really low, it permitted us to buy real estate, and that real estate was cash flowing positive, and we were able to pay back that debt. But if we wanted to, we could have kept the money, used them as investors, and we could have grown even faster. Okay, so if you like this kind of information, like, subscribe, and I'll be seeing you on the next video. Thank you.